What is going on, everybody? My name is Reda, and I finally got the time to sit back down and record a video, kind of a beginner's A to Z guide on charting stocks. Now, this is going to kind of open up a wormhole because I do want to make more videos in the future describing more in-depth topics, right? Like fundamentals or value analysis and whatnot. But besides any of that, I wrote a bit of a guide that I'm going to go off of today, and hopefully by the end of this video, the goal is that you understand how to chart from a relative perspective and you understand what it is that you're doing so that, you know, come market open Monday, you have a little bit of a deeper understanding as to what you're buying. So from the start, I just want to mention that you shouldn't be buying any courses on the internet or like $300 like support and resistance courses or anything like that. None of that stuff is really going to help you. Instead, I would say invest that money in tools that are going to assist you, right? So tools, data, something that will help your analysis in the long run. So with that out of the way, let's jump right into the guide that I wrote and we can move forward with that. So if you want access to this guide, I'll link it down in the description below. That way, maybe if you're the kind of person that likes to read rather than watch, the guide will walk you through everything. So you can see that the first highlight here, the first headline is what exactly makes up a chart pattern. So I want to describe this. Let's go ahead and zoom into this, and because I mean, don't really need the descriptions. I can just go over it myself, right? So a chart pattern is showing you where people are ready to buy, otherwise known, we're gonna have to mute that, otherwise known as demand zones, and where people are ready to sell, otherwise known as supply zones. So this concept goes back to just basic economics. If there is a lot of supply, that means that the stock should come down, right? Because there's more supply than there is demand. If there is a lot of demand, that means that the stock should just come up, right? This makes complete sense, I think. So that's all support and resistance is showing you. So support is usually a line of demand, and resistance is usually a line of resistance. Now, this being said, all a chart pattern, you know, people like to make fun of chart patterns because they're a bunch of different shapes, or, you know, investors make up funny names for them. But in reality, all a chart is doing is showing you a historical visual view, right? So it's like the company had an offering. Like if I went back into, for example, this is CRM, Salesforce, and I went to the 3-year weekly chart, right? If I go back, for example, if 5 years from now, and I come back and I look at this big drop, you and I, we're going to be like, coronavirus, we were here for it. But to a regular person, you know, they wouldn't understand what kind of happened here. So what they're trying to figure out is, throughout this entire drop, where did people go, wow, this stock is way undervalued, let's buy it back up. It's higher value than it is. And you can see that it was down at this level even before the coronavirus. Like, I wouldn't be able to tell you what this drop was. I wouldn't be able to tell you what this gain was, just because, I mean, I would be able to speculate, right? But all a chart pattern is showing you is where over time people are buying and where over time people are selling, right? So where is value over time? This being said, understanding this is chart patterns aren't finite, right? So you might have a line that's been tested and used 8 different times in a row, and perhaps the 9th time, the time that you buy, it just happens to break out. This is why risk management is very, 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 very important when you're trading, because you could have every single thing lined up, but you're going to be wrong eventually, right? So my idea is like, I'm going to be right 8 times. My goal is like, I want to be right 80% of the time. The 20% that I'm not right, it doesn't kill me, right? So when I win 2. When I lose 1, right? That way I'm winning over time. Now, this being said, if we go back into the guide, you can see that that's kind of what I explained over here. So, you know, there are visual reflections of supply and demand over time, and it's showing you where areas of support are where a price is constantly holding above, areas of resistance are where prices are holding below. Now, this is a very important term. When support breaks, it turns into resistance, and vice versa. So when resistance breaks, it turns into support. What does this mean exactly? So you can see that there's a support level here, right? It's pretty massive. So it was used here, 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 and here, right? But as soon as this support level was broken, right around this area, right? As soon as the support level was broken, we went up, right? And we came all the way back down to test this line. So this line was resistance here, here, and here. So we broke under the support. So this is the major support line, right? We broke under it right here. So around June 2002, we broke under it. and then we held under it, we held under it, we held under it, and when we came back to go over this line isn't support anymore, it's resistance, because that resistance level was broken, so people kind of lost confidence in it. So it took a couple of times before it broke out above it, and then it became support again. So that's very, very important. But besides that, there really isn't anything too crazy about that. Now, the one thing that I want to mention with support and resistance in charts, obviously, is the longer time frame you look at. So if you're looking at a 15-minute chart, for example, this trend has only happened for the last 15 minutes. In the grand scheme of things, 15 minutes isn't shit, right? So 15 minutes doesn't matter. That's what you need to remember. So the longer the time frame, the more powerful the setup is going to be. And don't worry, we're going to go into how I find these setups and everything like that here in a moment. So don't stress if you've got some questions here. Hopefully we can get them all answered by the end of this. So we understand now what a chart is trying to show you, right? But what the hell, if you showed this to a regular person, they would laugh at you, right? Like, what the hell are we even looking at? What are these weird bars? What's going on here, right? So I'm gonna go ahead and try to explain this in layman's terms, right? I think if I pull up something maybe that I don't have any lines on, let's see, the people's favorite, let's go with Tesla. Okay, so here is Tesla, and I do have some lines on Tesla here, but I'm pretty sure I'll be able to explain candlesticks using Tesla. It looks like I've got a version of every kind here. Maybe if we go to the 4-hour chart. Yes. Okay. I'm gonna go ahead and pull all of my indicators off of the chart, and we'll go ahead and explain. Apply. Okay. Alrighty. So basically, we'll start right here. So a candlestick is a relatively intuitive mini chart that's making up this whole chart. Now, the reason I say it's intuitive is because every candlestick either opens up green or red, depending on if the trade was higher than the last interval. So one candle represents one interval. So what do I mean by this? So you can see here 180-day 4-hour. This being said, this is being done on Thinkorswim. It's a completely free platform, but every charting platform is going to be exactly the same. So if you have any questions about the relay or the differences between any charting platform, feel free to leave that down below, and I'll make sure to answer that. But you'll notice that you always have two time frames. You have the 180-day 4-hour chart, the 1 day, 1 minute, or whatever you're deciding to pick. So the first time frame is the x-axis, right? So it's how long you're looking at. And the 4-hour time frame is the candle interval. So each of these candles, this one represents 4 hours. This one represents 4 hours. So together, they represent 8 hours of trading history, right? So if we're looking at a 180-day 4-hour chart, right, we're seeing each of these candles represents 4 hours. So altogether, the total time is going to be 180 days, but it's broken up into 4-hour segments. So every single candlestick will open up kind of looking like this one. So let's say the candlestick before this one was green, super green, right? Then it opened up trying to figure out, does it want to go green or red? So if it went red, the candle would come down, okay? If it went green, the candle would go up. Now, what do I mean by this? Let me try to find an example here. So you can see this one opened up. Let's see here. Okay, here's a good example. So green, 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 until this one opens up red, and then it goes all the way down, right? Red all the way down. Now, what do these little lines mean up here? So the candle is made up of two parts. The body, right? So this would be the body, and then the two wicks. Now, I'll show you this right here. Okay, so the candlestick opens in the middle. If it's going up, the candle will be green and it will go up, right? The candlestick opens in the middle. If it's going red, it'll go down. Now, the low and the high don't matter as much as where the candle closes. So the candle might open and go all the way down to 6. For example, let's say the stock is at 10. The next candle opens, and it's red, and it goes all the way down to 6. But remember, this candle is representing 4 hours. The whole time it's not staying down at 6. You understand what I'm saying? It's not continuing to make lower lows. So the candle opens, it goes down to 6, right? And then let's say it stops for a little bit and it bounces off of 6, it goes to 7. So there'll be a $1 wick in between 6 and 7. That's what I'm trying to show here. So if the candle opened, the stock is at, let's say, 10. It went all the way down to 6, okay? After it hit 6, it bounced a little bit and it closed at 10. It closed at 7. So it opens at 10, goes all the way down to 6, closes a little bit higher at 7, right? And that's the body. The body's showing you the open and the close. The candles are showing you the high and the low. And that's pretty much it. There are like candlestick patterns and stuff, but I don't really look at stuff like that because it doesn't, to me, I'm not looking at a chart as a definitive way to enter. But I will talk about a strategy that would make a chart a definitive way, or the ways that some guys in the chat room use the charts. But for the most part, I would say that candlestick patterns and such don't really matter too much. I would focus more on finite long-term patterns. That way you don't need to use a bunch of different indicators and whatnot, right? I think that just bogs the mind. So in this case, right, we understand, hopefully at least we understand candles. Now, if you have any questions, please do not hesitate. Leave a comment down below. So if we jump back from this just to a really quick example, you can see, let me go ahead and get rid of this. Oh, all right. Okay, then. It's going to stay. All right. Okay. Remove drawing, and remove drawing. Okay. So you can notice now that this candle, Tesla's a bit fluid, or a bit not so fluid sometimes, so it becomes hard. But you can notice, the stock goes up and up and up, and then it opens up and goes down, and it closes nearly at its low. You can see it makes this little bit of a wick right here. It makes this little bit of a wick, right? So that's the way candlesticks work. It's pretty intuitive. Sometimes you can have stuff with really long wicks, like you can see here. The high all the way was 1800, but it didn't close at 1800, right? It came all the way down to 1600 during that time frame. Or you can have really like no wicks. Like you can see this candle closed all the way at the high. There is no top wick because it started, it came down a little bit, and then it just zoomed, right? So that's those are a couple different circumstances. And remember, with experience, you'll gain a very, very quick mastering of this entire subject. It's not very hard at all. I would actually argue that you would be a master of charting stocks, or at least understanding the basics, which I've laid out here, within maybe even a couple of days if you really put the time in, right? But besides this, okay, so we understand candles now. Now is the big question, right? What are your favorite indicators? The indicators are going to make us money. How do we add the indicators to the chart so we can get some cash? Indicators, all they're doing is congesting what the chart is showing you. Don't forget that, okay? Although helpful, all they're doing is taking what the chart is showing you, the quick data, and making it very easy to look at. Now, that being said, I do like a couple of indicators, like SMA lines and EMA lines. I have a video on SMAs and EMAs. You can find that link in the description. But I do want to make a video called like an indicators in-depth series where I go over my favorite indicators and talk about who invented them, how long they've been used in history, blah, 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 blah. That way you understand what it is you're looking at instead of just looking at it and trying to figure it out. So if you want that content, please make sure to get this video, I don't know, let's say 20 likes, and we'll go ahead and make a video about indicators in depth. But for the most part, understanding indicators and indicators you're not really going to need for this specific strategy, because the setups I'm about to show you are super duper powerful without indicators that you don't really need them to understand what it is that you're buying, as long as you're buying safe, long dated, as long as you're buying at a good time. So do you need indicators? Yes. I mean, it would make it easier, but are they necessary? 100% no. You could do this with a line graph. You don't even need candlesticks if you want to make this super simple. But yes, indicators in general can help you out, and if you're buying at strong support and resistance, it doesn't really matter so much. So in the future, we will make an indicators in-depth video. Now, what time frames are the most important? This is a very popular question, right? So modern platforms allow you to look at all kinds of time frames. You want to look at the 15-second chart? You can look at the 15-second chart. You want to look at the 15-year chart? You can look at the 15-year chart. If you want to look at the 5-second with 1-second candles, you can do that. If you want to look at the 15-year with 1-year candles, you can do that, right? So what the hell? What am I supposed to do? What time frames am I supposed to look at? This, to me, is totally up to your own preference. For me, the longer the time frame, the more powerful it is. Don't ever forget this. The longer the time frame, the more powerful it is. Now, if you wanted to, so a setup like, for example, the one that I showed you before, CRM, and I will go through how to find setups and stuff like that. So you can see CRM, these are pretty solid lines that have been used for a long time, right? But if I go from the 4-hour, for example, to the 1-year, 1-day, the lines are still just about the same. They're not really changing too much. Of course, you can adjust this here for the gap or whatnot, but for the most part, they're just about the same. And this idea, let's see, what's another good one? I've got a couple over here. Make this a little bit easier. Facebook. You can see these lines are a bit crooked, right? So let's say we wanted to remake these lines. If we want to remove this drawing, right? That's Facebook. And we're going to go ahead and remove this. Sorry. You can see these lines on Facebook, for example, they're pretty solid, right? But if I go from the 1 year one to the 4 hour chart, you can see the 4 hour just makes it easier for me to view these lines in a deeper respect. So my favorite time frame is the 180-day 4 hour chart, because if I go to like the 1 year 4 hour chart, it just makes it super annoying. It's too, you can't see anything, right? And if you may go to the 1 year 1 day, the candles are too big and it makes it very clunky. I found that for super long term setups, my favorite chart is the 180-day 4 hour chart. That's just what I like to use to find these setups. So, you know, general rule of thumb, longer time frame, more powerful setup. So if you want to put some hard cold cash into it, right, and you want the play to work out in your favor, maybe you want to take the play and go to work without having to worry or whatnot, definitely I would stick to around the 180-day 4 hour range. So, actually, on that bombshell, a good analysis here, because a lot of people ask me about my specific trading style, and you'll notice, I'll go over here to the analysis. You'll notice that typically I'm holding for about 2 hours, right? And that is because I'm buying on these long-term setups, so it doesn't matter so much. So you can see it makes it very easy for me to stay super consistent. My idea isn't to like make $1 million on Tesla. It's more I want to make a couple $1,000s a day for the rest of my life, right? So for a super controlled week with safe contracts and you know, this week was a bit choppy. If you don't know what that means, it's like up and down, up and down. It's very hard to read. I like to just take risk. I like to pull back my risk and just take super controlled trades. So for the weekly summary, you can see here, like I had 7 green trades, 1 even trade, and 0 red trades. And that was all literally just using the same charts that I'm about to show you how to find. So it makes it very, very easy to you know, print cash per se, right? So besides this, let's see here. We went through the time frames and how to use charts to make money. Okay, this is you know, we're pretty close to the end here actually. So you can see. So now we've talked about charts, we've talked about candlesticks, we've talked about time frames, and the only thing left is we also talked about support and resistance, demand zones and supply zones. So now let's talk about how to actually make money using the information you've just you just heard, I guess. And then we'll go through proper risk management and the market's most recognized chart patterns. Although even if you watch this video as an entirety, I'm going to go ahead and tell you why these patterns work, right? That's the idea, is that you understand why these patterns work. So all right, now you understand charting, you want to make some money. You get it. You got to draw fancy lines to show where things are bouncing, right? We get it. How are we going to find the things to draw the lines on? My absolute favorite website to do this is completely free. I'm not affiliated with them whatsoever. They're just my favorite site. Bar chart. So there are a large cap. They're showing you large cap volume leaders, right? And what this means is we're getting stocks that trade at a high enough market cap so that we don't have to worry about things like liquidity. So liquidity is how much money is flowing into the trade, so how easily you're going to be able to get in and out. So as long as your trade has good liquidity, then you don't have to worry about things like volume and whatnot. And later this week, I actually already have it scheduled on YouTube. I'm dropping a video called Understanding Options Volume. I'm also dropping another video called like what in the world is a market maker or a liquidity provider, because a lot of people get those terms mixed up and they don't really understand that stuff. So, you know, subscribe so you can watch those videos in the future. But for the main part, for what we're doing right now, just understand that this list, this is the top 100 volume leaders. If you're getting a play off of this list, for the most part, it's going to have actually not for the most part. In general, I would say that this would have the absolute most voluminous, highest liquidity trades on the planet. I don't think that you would be, you know, maybe sometimes they won't end up on this list, but for the most part, it's been pretty reliable for me. So what I'll do every single weekend, because these are such long time frames, the setups last for a very long time. So you don't need to do it every day or anything. That's just, I feel like that's a waste of time. But usually I'll go through about 25 of these, 50 of these until I find 6 or so that I like. So you can see in the master guide to trading, in the master guide that I wrote here, we had Disney, MU, and Twitter all on the 1 year, 1 day chart. If we go to Disney, okay, we're going to go ahead and get rid of that really quickly. Okay, so if we go to Disney, you can see that this line still exists here, right? If we go to MU, line still exists. Although, you know, we came back down below it. You could have shorted it right here because it broke under support, right? Disney, MU, and what was the last one? I believe it was Twitter. You can see that if I go ahead and, these were some intraday lines that I drew. Go ahead and remove this. Okay, you can see that this line still is very solid. You can see we actually came down below it, and then we went right back up to test it, and then we came, you know, we rejected it. So you can see this line still is working, even though this guide was written about a month ago. So you don't have to do this very often. Once you've done this, like for like 6 weeks or so, you're going to actually have a very good understanding of your favorites to go through. But for the main part, we'll just do a couple here. So we'll start off with NIO, mRNA, Ford, and American Airlines. Most of these I'm probably going to have. NIO, this is a Chinese, a Chinese Tesla, basically. And if you, for example, this line, look, it's a long time ago, right? Let's see here. So anything that's like super parabolic like this, I kind of try to stay away from because it means it's got a lot of volatility. And to me, it's like, again, like I said before, consistency is the key. I would rather, I measure my productivity in the amount of red days that I have. I try to stay under a handful of red days per year. That way I know that I can create a consistent income throughout all my strategies. But for the main part, if we were gonna go like this, you know, it's there, right? You can see it. Yeah, it's there. But what I take, I mean, you could take the setup if you wanted to, but you know, the idea here is like, look, you're looking at a 180-day 4-hour chart. 3 times in a row, it had to test this line before it broke out, right? So if you're buying things every time at these heavy setups, more than likely or not, so if you go, okay, this time it broke down, okay, so this time it broke down, this time it broke down, this time it broke down. If you bought it here, right, and you go all the way from $8 to $6, you would have made $1.20 a share, right? So you would be up, you'd be up about $1.20 a share. Or if you were doing options, obviously we would measure this in percentages. But in the future, I will have an options video, and I'll have all those linked in the description as I make them. So, but for example, if you sold it here at you shorted it here, you sold it here, and then you buy it here, and then you get stopped out because it goes down like 20 cents, right? Or I usually give myself like about $1 worth of leeway, but this is a cheap stock, so we'll say like 50 cents worth of leeway. So it goes down, right? You stay in, and then boom, it explodes, and you made another $2 there, so you're net $3. So when you go to short it right here and it breaks out, right, you would have lost about 50 cents. So you would have net $1.50 just following these lines, right? And that's how these kind of lines work, right? That's the way that you should think about them, is I'm buying at very powerful support, I'm selling at very powerful resistance, and more likely than not, I'm going to be right. But make it so that you're not taking crazy trades, right? Don't put all of your account in one trade, because there is a chance that you could be wrong. You want it so that the 80% of the time that you're winning, you're making at least double when you're losing, right? So be very, very quick to say, hey, I'm wrong, right? Or not too quick to the point where like this is the tricky part, right? So give yourself enough leeway. I would say about $1 is good leeway. And when you're going up, because you're buying at these very heavy support lines, you can kind of ride it and take your profit slowly as it's going up. And I explain this every single day in the chat room. So if you, for example, wanted to learn, like watch me do it in real time, I'm live all day doing this kind of stuff. That link is always in the description, but of course you don't have to. You can gain your own experience. It doesn't matter. But anyways, this was that was NIO. Let's do we'll just go to American Airlines. We'll do 2 of them, right? And then I'll go through some of them that I have from times past, right? So this is American Airlines. Now, the thing I like about American Airlines is that the airlines, remember, I wouldn't trade something like this because I'm not a fan of things that have all kinds of people watching them. Because what happens when all kinds of people are watching, something is that you get screwed. You know, somebody's better than you, somebody's smarter than you, and you just happen to get screwed. But for mRNA, you know, if we just go to this part right here, right? Breakout, resistance, 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 resistance. I mean, look at how many times, right? So this would be like a huge, huge, huge resistance line, and then it finally breaks out over it, and it goes back to nearly a previous line, right? This kind of stuff, I mean, this is AAL. We did Facebook earlier. We can go through Facebook. This one's easy, right? I mean, very simple. Resistance, resistance, resistance. And I actually made money on Facebook a couple of weeks ago. Hold up. Literally off of these lines. Let's see here. Let's see here. Oh, shoot. Wrong channel. Disney. Facebook, right? So 20%, right? I leave 20%. And then Disney, Facebook again, right? And then I left 10%. You know, I played Facebook for a couple of days, actually. It wasn't even one day. And you see, I'm very quick to cut my losses, right? But don't want to hold Facebook overnight. I'm leaving at $5. Blah 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 blah. Right? But you can see, I'm practicing what I'm preaching, right? So it's not something. It is something that works, right? Yeah, it's very very interesting and it does work. It is something that you can implement. If you wanted to join the chat and just get my line, because every single day I'm actually, go to the idea box here. I'm actually posting my favorite setups from every single day and like what I think is going to happen throughout the day. Like here we have Disney and so on and so forth. If you wanted to just join and look at these, I'm going to leave the link down in the description below. It's completely free to join and like start looking at this stuff. But of course, again, you don't have to. We do have tools that are a bit more professional, like options flow, and we are talking about plays that are a little bit more advanced. But if you have the intuition or would like to learn, then I would definitely say this, the community of a couple thousand people can definitely help you. But for the main part, I'm posting setups like this. So I definitely do practice what I'm preaching here. But if we go back to the line, so essentially what we're doing is we're waking up on Saturday and we're looking at the top 100 volume stocks and we're going through them to try to find our favorite 6. Once we found our favorite 6, right, basically, because, I mean, if we bought Disney, for example, at 115, right? So look at this line. Here, and here. This was a month ago, okay? If we bought Disney back then, let's see. I'm willing to bet the price is 119, right? So this is very, very, very interesting. So you can see bounce. We bought it around this region maybe, and then it goes all the way to 120, right? So you would have made $7 a share. If you were trading options, you would have made 200%, even on long dated contracts, right? But super duper easy. So that's the idea, is that we're buying at very, very heavy support lines that have been used for 7-8 months and they're super strong, and we're selling at very, very heavy resistance lines. And then as soon as it breaks over that line, we can be like, hey, we're wrong, and we just move away from it, right? But that's risk management, right? So obviously most of us don't have enough money to go around buying tens of thousands of shares of Apple for a 4-hour trade. So the way that you would be able to take advantage of this is with options. Now, I don't want you to start trading options just willy-nilly without really understanding the intricacies. So that's what we're primarily doing in the chat room. If that's how you wanted to learn about options, you can definitely join. That link is always in the description. But I will make a video in the coming days describing options and how you can actually use this exact same strategy to trade options, right? But proper risk management is like, I'm buying stocks with a lot of I know these stocks have volume and liquidity. I don't have to worry about that, right? So I'm buying them at heavy support points. I'm selling them at heavy resistance points. Once it moves about $1 away from my support or resistance, I'm like, okay, I'm wrong. I can just cut it and I'll be completely fine. And it's super duper simple. It's not the craziest thing. So this is the idea of investing proportional capital. Remember I said earlier, you don't want to throw your whole account in this. Now, the reason this is true is because remember, we're talking about if I'm taking 10 trades, I want to win 8 times and I want to lose twice. So what happens when I lose twice? This is the goal. Sometimes I honestly I can go 20, 30 times without losing, but this is just the way that this happens. So if you invest in Apple, so let's say you take your money, divide it into 3. Okay, so you invest. You have only $600. You invest $200 in Apple on Monday. Actually, you wouldn't even be able to buy a share of Apple, so it would have to be options. But you invest $200 in Apple on Monday at a demand line, right? So this is support. So you're buying Apple long. Okay, so long means that we're betting that the stock will go up. And then you invest $200 in Apple on Tuesday because you rode it all the way. Okay. So you on Apple, you ride it all the way from support to resistance, and then you start shorting. On Tuesday, you short Apple, right? Because now it's at resistance. And then you invest on Wednesday on Amazon. There are only 2 possibilities. It's either the stock moves 1% away from your line or $1 away or whatever, or the stock makes a $5-6 move. So because these are long time frames, each candle represents 4 hours. So that's like a $5. It could be a $4 to $5 move on average. So if you're losing about $1. If you're winning, you're maybe making $3 to $5 depending on where your exits. I usually like to exit as it's riding up because I'm very, very stingy with my money. So that's the way that I would do it. And in this way, you would ensure that whatever happens, you're making a good amount of cash even during chop, right? So it makes it very, very easy to manage your risk. And because they're such powerful setups, if it moves below that line, you better believe it's making a move. So you have enough time to be like, hey, I think I'm wrong. It's time to leave, because it'll be a large enough move for it to be significant, right? So that's what all I'm explaining here is like, it takes such powerful monthly setups, right, that have repeated strength. The likelihood of a move at our line is pretty high. The majority of the time, we're going to be riding a winner. But when we're not riding a winner, you're going to know that you're not in a winner, and it's just time to leave, right? So this just goes on to explain the chat, but I already talked about that previously, so I'm not going to go into that. But let's talk about the market's most recognized patterns, okay? Remember, patterns are just visual representations of support, which is demand, and resistance, which is supply. Our goal is to draw powerful support and resistance lines. You're probably going to have seen these patterns before. They're easily recognizable. So you don't need to understand like this one's called a freaking spinning triangle or yellow green. None of that stuff, dude. You don't need these names. But just in case somebody says it in the future, maybe it's a good it's an idea to it's something to have a good understanding of. So probably the most popular, I would say, is channels, and channels are, oh, I did that on mistake. Channels are something like Facebook, right? You can see you got a channel right there. The reason this works is, long dated support, long dated resistance. This is a multi-bottom, multi-top. Same thing here. This is so you can see that multi-bottom. That means the bottom hit more than one time here, and then it broke it, and then it went past it, right? So it broke it, and it went past it, and then here's the multi-top, top, and then top, right? So that's a multi-top, multi-bottom. Next one is a falling wedge. This one's super simple. Remember, we did NIO. Or this one would be actually a bit of a rising wedge, I guess. It's a bit of a megaphone. It's kind of going up slowly. But yeah, so rising wedge is up. Falling wedge is down. Easy peasy lemon squeezy, honestly. Falling wedge, rising wedge. Very, very simple. You're just, if it's at the top line, you're expecting it to break out. If it's at the bottom line, you're expecting it to break down. Okay, head and shoulders. Now, do you need to know that this is a head and shoulders, or can you just tell me, okay, it tried to break over this line 3 times, 3 times over, it hasn't been able to break it, and now it's back down at the bottom. What's the likelihood of it bouncing off of here, right? It doesn't matter, because as soon as it breaks down below this line, it's probably going to make a move down, and we can see a head and shoulders probably on. Let's see if I can. Microsoft, I believe. Let's see. So Microsoft, Tesla. I mean, even something like Alibaba. Remember, we were talking about that rising wedge. Look at this rise, beautiful. Look at how many times it's respected this line until it finally gapped up over it, right? Like when this thing gaps up over it like that, I'm cash by close, so this wouldn't happen because this would be that the market closed and then it opened at 233. But you would have only lost $6. Imagine how much money you would have made. I mean, just from here all the way down to you could take profits here, you could take them here, but just from here to here is gonna net you $10. So if you end up in this gapper and you lose what is that? You lose $8. You're made $8 here, $8 here, maybe $4 here. You made a bunch. These are very solid lines that go on for a very long time. So even when this thing breaks out, so like, hey, it's time to get out. This thing freaking gapped up. Whatever. I made money every other time, right? So you're making more than you're losing on average. That's the whole point here. But besides that, stuff like head and shoulders and all this, like you can go head and shoulders and triangles and cup and handles. The only reason this stuff works is because, okay, we know that this line is support because it bounced off here and here. It finally broke under support right here, right? So it goes up to test it again as resistance. You can see this green candle right here. See that? Look at that wick, and then boom, right? So it was unable to break resistance, short it. Same thing here, up, down, up, down. Look at this. for yourself. Up, down, up, down, up, down. And then whatever side, so if it's at the top, break out. If it's at the bottom, break down. Easy peasy. Cup and handle. This one right here, right? Honestly, all you need to worry about is this little part at the end right here. This massive cup, and then it forms just like that. It forms a channel just like that. Where did we just see a channel just like that, actually? Let's see. If we don't worry, I believe, hold up. Let's take a look. CRM. See, if this thing had a cup right here, if it went, woo, would it matter? Or is the only thing that matters this part right here, this channel that I have drawn? Would it matter if this thing went, woo? No, it doesn't matter. It doesn't matter at all, right? So this left-hand portion, like whatever. All we care about is, okay, it's forming resistance. It's forming support. It's forming resistance. It breaks over resistance and breaks out. That's all that matters. Same thing here. Support, 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 support. And it's unable to break all the way forever. Finally, it tries to test it and it breaks down under the support line. You can say, okay, I'm going to take a short. That's all these patterns mean. Now, it's important to know these names because other people might want to talk to them or other people might want to talk about them or whatnot. But basically, this was it. You know, if we do a quick review over what we talked about, you know, we talked about chart patterns. We talked about chart time frames. We talked about drawing lines. We talked about how to find stuff to draw lines on. And we talked about understanding risk management a bit. Like I said, for the next couple of days is, like I said, a quick recap is I use this every single day and I make money with this every single day. You saw it for yourself, right? You can do this on your own. You don't need me. You don't need anybody to help. You don't need to pay for somebody's $300 course. Do this on your own. That's the first thing. The second thing is, if you are interested, there's thousands of people in our chat every single day trying to learn this and learning from me, right? Learning from the things that I do because I'm live. I'm there all day because I'm trading all day anyways. Might as well just put the microphone on and talk to you guys, right? So if you would like to learn that way, or if you want to be in a part of a community that's using tools that are intuitive and trying to trek forward, it's completely free to get started. That link is always in the description. That's the second thing. And the last thing is, if you like this content, right? If you like videos like this, where they're relatively intuitive and I'm trying to explain to you the ways I actually make money, then please leave a like down below. We get 20 likes this week. I will drop a understanding what market makers and liquidity providers are. I'll make a video on options volume. And then in the next coming weeks, I'll explain to you my favorite indicators and all the history and all the reasons why they work. And I'll explain to you how I use those indicators along with options properties. So that means we're opening up a can of worm formula. So we're going to make the master guide to options. I'll explain how all of this comes together so that I can be profitable, right? That way you can learn from my mistakes and you can add a sprinkling of your own experience into it and use this information to print cash. But with that all being said, this video is effectively over. We talked about everything that I want to talk about now, and hopefully hopefully over the next coming weeks we can make a couple more videos that dive very, very deep into the wormhole of understanding this whole thing. It's not as hard as you think it is. Thank you so much for watching. If you have any questions, drop it down below. I will see you guys in the next one.